Hey traders! I am very glad to see every single one of you on our sixth webinar of the series of our ADAS marathon of webinars. I'm extremely happy to see every single one of you. I already see some comments in the chat, but let's start with a quick tech check. First things first, if you can please type a plus in the chat just to know if you can hear and see me clearly. If everything is working fine, please put a plus in the chat so I know that everything is working and we can get started and dive into the topic of our today's webinar. Who do we have here today? I see that TickPete is putting plus. Thank you so much. Thank you for your feedback in the chat. Fantastic. I love seeing it. It means that everything is working fine and we can get started. So welcome everyone who's been with us over the past few weeks of the webinar. This is the sixth webinar of the series, so I'm excited to have every single one of you. Let us know in the comments in the chat, where are you tuning in for today's webinar? We are excited to get to know you better. And a special welcome to every single one of you who is joining us today for the first time. My name is Anastasia and I'm a full-time trader with 8 years of experience and ADAS expert. I started back in 2017 trading crypto markets and then moved into the Forex market. And for the past 4.5 years, I've been trading specifically for futures, US stock market futures, commodities futures, gold, oil, and this has been my focus. And I've been trading it with nothing else but volumes, indicators, volume-based analysis, and order flow, everything that we've been discussing for the series of our webinars. So let's see who do we have today in our room. Can you please type 1 if this is your first time tuning in for our webinars? And can you please type 2 in the chat if you attended our previous webinars in the past few weeks? So 1 if you're here the first time, and we welcome you dearly. And 2 if you are with us already for the past few weeks and we are excited to see you as much as we were before. Okay, I see some pluses. Everyone is tuning in. We see some amazing. We have lots of you who've been already joining the previous webinars. TickPit is here for the first time as well. Welcome. Welcome. Watch the recordings. Fantastic. Excited to hear your feedback as well. So please do let us know the feedback about the previous webinars and anything that you would love to see also in the next ones. And thank you for the answers. I see all the answers. And once again, you've picked the perfect time to jump in if this is your first time with us, because today's topic is highly relevant for absolutely everyone. So let's have a look at what we already covered so far in our previous webinars before we're going to move into the topic of today's one. So over the past 5 sessions of our webinars, we've made some serious progress. Okay, so let's quickly recap everything that we've already have in our toolkit. So first things first, I have some notes here. So first things first, on the webinar number 1, we talked about market mechanics through lens of order flow. So we broke down the 2 types of orders: market orders, aggressive order flow, and passive orders, which is the limit order flow. We looked at how prices formed through the market auction, and we were introduced to the depths of market, smart tape, and got our first look into the footprint charts. We also, on the second webinar, talk about the bid and ask logic, traces of big market players. So we covered how the aggressors move the market and who is on the passive side, stopping the market from moving. You also learn how to read bid and ask activity. We explored imbalance and how it's visualized in ADAS platform. In our third webinar, we covered vertical volume and its connection to cluster analysis. So we discussed the vertical volume, so volume bars, how it interacts with clusters, and we looked for spikes in activity and what they might signal, as well as several practical setups that you could apply immediately after the webinar is over. On the fourth webinar, we talked about horizontal volume, the things that not even one of my analysis gets without. Like, I use it on every single day basis, and I back every single my analysis using the volume profile and TPO. So we covered how the price-based volume profiles are built. We also talked about the value area high, low, and point of control zones, and how to identify levels of interest for large market participants. And finally, on our previous webinar, we learned how to find key entry points using order flow. You learned about absorption, imbalance, and stacked imbalance different signals for entering trades. We reviewed how to spot them on the footprint chart, and you also got ready to use ideas for entries and stop loss placements. Just a quick reminder, you have a lifetime access to all webinar recordings. So here is a question, okay? If you want to review any of the previous sessions or refresh your memory and your knowledge, you just use the links that were sent to your email on the day of each stream, and you can rewatch everything from there. So now, with all these tools in our hands, you already know how to read the footprint, spot imbalance and buy seller's aggression. You already know how to identify key zones of volume and strengths, build clear thought through entry scenarios, which brings us to the number one question every trader eventually faces. What do you do when your trade goes wrong? How do you limit your losses? How do you protect your capital and stay emotionally balanced? How do you size your position wisely and manage your daily loss so that a losing streak doesn't wipe out your account? And that's exactly what we are diving into today. Risk management is something every trader knows they should take seriously, but however, most people don't actually do anything about it. If you've been trading for, let's say, over a year, but still aren't consistently profitable, chances are it's not a technical problem. It's a human problem. And the sooner you realize that, the faster you'll stop blowing accounts and start seeing different results. So you've probably heard hundreds of times that you need to manage risk, keep a trade journal, follow a clear trading system, and have a set of rules. But how to actually do that? How do you protect yourself from costly mistakes? How do you stop giving your profits back to the market? And how do you finally start seeing consistent gains? That's exactly what we are talking about today. So let's jump into the main part of our today's training. And just a heads up, if you have any questions, please don't hesitate to put them in the chat at any moment throughout today's webinar. And in the end of our today's webinar, we're going to have a block of questions and answers. And during this Q&A, I'm going to go through your questions and do my best to help you with every single one of them. So don't worry, if your question wasn't answered yet, I'm going to get back to it in the end of our today's webinar. And I already see some feedback about the previous webinars. They were great, absolutely amazing. Thank you so much. Thank you, fantastic. I love hearing this feedback, and I really, really appreciate your trust that you put in us being on today on these webinars. And we do hope that it helps you to get to the next level in your trading as well. So before we dive into the specific rules of risk management, I want to ask you one very important question. Do you actually know who you are when it comes to the trading? Do you know which type of trader are you? Because risk management isn't just about numbers. It's about their personality. It's about how you react to fear, to loss, and to pressure. And if you build your rules based only on someone else's experience, without considering yourself, your mindset, your pace, those rules will only hold up until your first emotional spike. So I always repeat this phrase, and I often use it in terms of my students as well, that the problem isn't that you lack discipline. The problem is that you are trying to follow a system that just doesn't work for you. So trading is a daily encounter with fear, doubt, and uncertainty. And if your system goes against your natural temperament, it will end up breaking you. But if your system is built deep within understanding of your own strengths and weaknesses, this will support you. So why it's important to know which type of trader are you? First of all, each of us has a different level of risk tolerance. Each of us makes decisions at a different pace. Some people are terrified of missing out. Others are terrified of being wrong. Some will hold on until the losing trade, hoping it will eventually come back. And others will panic at every tick against them. Now, knowing your type means that you can stop copying other people's strategies and start building a system that's actually yours. So let's break down 4 general trader personality types. And yeah, I know we're going to get into the slide a little bit later. So don't worry about that. We're going to look at this slide for a moment, and then we're going to continue into the next ones. We have a lot in front of us, so please stay tuned. So first type of the personality of a trader is a scalper. Let me actually bring back my camera so you can see me clearly. So the first type is a scalper. Usually the scalper in the mentality of the newbie trader is someone who takes 100 trades a day. And trust me, I've seen people who trade 50 to 100 trades a day, and that's exhausting. Scalpers usually operate on low time frames, use a low risk to reward ratio, and their typical mindset is the more time I spend in front of the screen on the charts, the more money I will be eventually making. What this reveals about their psychology is that they usually have high anxiety, they have a strong need to control, and they cannot stand waiting. They want instant results, and they tend to overestimate their ability to outsmart the market. Usually, scalpers also easily slip into fatigue and the burnout because of how much emotional charge it takes to stay focused on so many trades at once. What kind of risk management works for scalper is, first of all, strict time limits. So only trade specific amount of hours per day, because the longer you will be in the markets, the more exhausted you will become and the more difficult it will be for you to make comfortable and disciplined market decisions and quality market decisions. Because the more time you spent on the charts, the more trades you took, the more decisions you made, the more your vision gets blurred and the more difficult it is to stay cool-headed closer till the end of the trading day. So set yourself strict limits for trading time. Let's say I only trade 1 hour, 2 hours a day, and that's it. Make sure that you have an auto break after 3 losing trades in a row. It can be 2 trades, it can be 3 trades. It's something that you need to adjust to yourself, but it's something that I find really working for people who are more of a scalper personality. Because if you don't have the auto break, emotional spiral tends to take them into the emotional charge to the point that they start blowing their accounts or taking massive losses in a matter of 1 day. Whereas if you have an auto break after a specific amount of trades, it will help you to step away from your screen. It will help you to take a break, to cool off, and come back stronger, getting ready to take the next trade without being emotionally attached to the previous one. And make sure that you have something what is called the written list of anxiety triggers, situations that mean it's time to close the platform and step away. It can be that you start feeling fear or FOMO, fear of missing out, or you start revenge trading. This can only be done by analyzing your past performance and mentioning where did it go wrong usually. So mark yourself an emotional charged trades and find out what is similar in majority of them, which emotional triggers did trigger the losses afterwards, and what was the time that you needed to close your laptop and step away. And once again, coming back to the previous point, the auto break actually does help a lot in this. Second, it is the intraday trader. I'm an intraday/intra-week trader, so it also applies to me. Now, they usually have the medium risk to reward. They work on 5-minute to 30-minute or 60-minute time frames. And what this reveals about the one psychology is that they are more or less balanced between speed and patience, but however often struggle with FOMO, fear of missing out, and information overload from, for example, news or amount of charts. We can flip back and forth between intraday and scalping styles if you're not feeling comfortable with your own trading system. This is why it is really important to work it out and have the strict trading system that works for you. And what kind of risk management works for me is that, first of all, I have the predefined entry and exit points before I even enter the trade. So before the price even comes into the zone of my interest, I already know where I'm going to be entering and exiting my trade. As I usually say, that if you don't know where your stop loss should be or your take profit, you shouldn't be in this trade in the first place. So make sure that you have the strict entry and exit rules as well as scenario cancellation levels. Secondly, the one trade per day. Something that helped me a lot and was a breakthrough in my trading career is when I started focusing on finding only one quality setup per day. It, by the way, also works for scalpers, but I find it more difficult for people as scalper mentality to stick with only one trade. However, it is something that can help you a lot. If you have only one trade per day, you start being really selective with the opportunities that you take, and it helps you to find the quality setup instead of going for the quantity. You can have the trading body that will help you and control you, as well as being responsible for helping you to control yourself of only taking one trade a day. You could have an expert advisor or the automatic break system that closes your trading platform or trading account for a day after the one trade was already taken. And you can help yourself with different technical aspects to only focus on one trade per day. At this point, it is about your discipline and it is about your consistent results. So beside this, also what helps me a lot is to take a break every certain amount of time to reset emotionally. If I come in the market in the morning as an intraday / swing trader / intraweek trader, and I see that there is nothing of my interest, I'm not going to keep staring at the charts, expecting the market to suddenly create the situation that is not there. If I see that there is nothing interesting, I'm going to set my levels of alarms in ADAS, so ADAS can notify me when an opportunity comes, and I'm going to step away from my laptop and come back later to check on market again. So I don't keep staring at the charts, and this is extremely important because the longer you stare at the charts, the more the human nature kicks in, and we start feeling like market owns us something. It almost starts feeling like the more time I spend on the charts, the more market owes me today's salary for all my time and effort spent, which we all know is not the case. The third type of trader is a swing trader or intra-week trader. They typically use a high risk to reward ratio and trade and analyze on 1 hour, 4 hours, or higher time frames. What this reveals about their psychology is that they have calm pace, they lean towards analytical thinking, but often suffer from analysis paralysis. I think too much and too long before taking a trade. They can wait for weeks for a setup and then miss it because of the doubt. And what kind of risk management works here is that they scale into position. So they enter in parts and they add to the winning positions. They use automatic stop loss and take profit placement to reduce decision pressure, as well as a trailing stop. And they limit the number of instruments tracked to only a few maximum at a time. And the last and fourth type of trader is a positional / investment trader. They usually have no stop losses, use hedging, and long-term holding. What this reveals about their trading psychology is a very high risk tolerance. They are comfortable sitting through drawdowns if they believe in the idea, and they tend to build 1 year ahead scenarios and may ignore exit signals. What kind of risk management works here is obviously hedging, dividing capital into active and passive allocations, using options, futures, and different other instruments to hedge against the losing trades, and planning your exit from a losing position before you enter a trade. It can be the macroeconomical trigger or the technical trigger, whatever works within your trading system. So before we're going to move on, Yes, I know you should be only seeing me right now, and we're gonna be moving right now. But before we're gonna do this, can you please drop a number in the chat? Do you tend to lean more into scalping? That put one in the chat. If you consider yourself a scalper, if you trade lots of trades on a small time frame for a short market moves, can you please put one in the chat? Can you please put two in the chat if you are more of an intraday trader and you only take a few trades or one trade per day and you close it within one trading day before the overnight layover? Can you please put 3 in the chat if you trade within a week? So your trades run between Monday and Friday. And can you please put 4 in the chat if you're a positional or long-term trader or investor? This will help me to adjust the rest of our webinar to fit your needs the most. So 1, 2, 3, or 4, please choose something that works best for you and let me know in the chat. I'm eager to know who do we have with us today. Okay, I see lots of answers. We have lots of different types of traders here. That's awesome. One, but trying to become two. Lots of twos. Mixture of scalper and intraday trading. Great, amazing. 1, 2, 1, 2, 2, 3. Great, fantastic. 1, 2, 1, 2. This is awesome. Because next, what we are going to talk about is how each time can adopt their key rules of risk management. And this is amazing to have all of you different types of traders with us today, because it also shows that something that is really important is to know what works for you and to follow the system that works for you instead of trying to follow someone else's steps. So now that you've answered the previous question based on your conscious mind, so something that you think about yourself, next I've got something very interesting for you. I've got 2 quizzes for you, which will help you to precisely identify who you really are in the trading world, not what you think about yourself, but what you actually do when you are in the market, even if that's unconscious. First test is extremely simple, but this will require honesty from your side as well as personal effort to answer these questions, because unfortunately I cannot control you, right? Or fortunately, of course. So you need to be disciplined enough and willing to answer these questions. So imagine the situation now. You've just had 10 winning trades in a row, meaning you've made around 10% of your account in just a few days. Now, take a step back and think. You just had an extremely good run. What are you going to do now? First, will you increase your lot size or stick to your current risk parameters? Let me know in the chat. Are you going to be increasing your lot size or stick to your current risk parameters? You can put the chat increase or stick to it, depending on what you would do and on your personal preference. Increase your lot size or stick to it. Okay, we have a couple of you saying increase. Increase, I shouldn't do. Stick to it. Put my system based on profits, not my margin. Great. Withdraw. Maintain lot size and continue to act consistently. 50-50. I think for day one, I will try. Okay, before we're gonna move on, right? Let me tell you my own perspective and what does it mean. Now, we all know that market works in phases. And usually after a very good run, it is a very tight line between adjusting your risk management based on your new account size, because your account just increased. However, not over-risking it and not becoming overconfident and letting your emotions lead your decision making. So when you decide either to increase your lot size or to stick to your current risk parameters, you should always keep in mind that good runs have an end, and bad losing streaks also have an end. At some point, after you had lots of winning trades in a row, there will come a point where things will start going wrong. not because of you necessarily, but because of the market. The situation in the market can shift. The macroeconomy can shift. Trump can come up and say something that will completely turn the market heads down. And this will affect your winning streak. So when you make a decision, you need to focus not on how much you can make if the winning streak continues, but how much are you willing to lose and accept the loss if right now at this very moment the winning streak will end and the next trades will be losing ones. Always before making a trade, what helps me is I ask myself, am I going to be regretting this specific loss? Or am I willing to accept this loss? If I'm feeling like I'm going to regret this loss, I shouldn't be taking this trade in the first place. I should step away, think about my next risk management plan, come back later, because it means that the moment the trade is going to go in the drawdown, I'm going to feel lots of emotions. I'm going to feel fear. I'm going to feel anxiety. I'm going to feel despair. I'm going to feel regret. And this all will affect my decision making. If I feel like I'm willing to take this risk, and if the trade goes in the drawdown and against me, I am not going to regret it later. It means that this is a good trade. It is within my trading system. It is within the risk tolerance of my personal tolerance at that very moment. And it is their healthy decision to make right now. So, second question that I have for you: how will you protect your gains and avoid overconfidence? Now, this is something that you can obviously answer to yourself, because the answer in the chat will be too long. But if you wish so, you can also share it with us. And I would really love to hear your feedback on how you will protect your gains and avoid overconfidence. But that's something that leans back into what I just said. Now, first things first, you also need to know what is your risk tolerance per trade. Even if your account increases, sometimes it's not a good idea to increase your risk per trade, because every single one of us has our own set of risk tolerance and money tolerance. If I've been earning X amount of money and I suddenly have my account at XXX 3 times higher than my usual account size, chances are that I'm going to start losing it, figuratively speaking and literally speaking as well. Because I'm going to start feeling pressure, I'm going to start feeling fear, I'm going to start feeling anxiety, because I'm not adjusted and used to this amount of capital and risking this amount of money, because this amount of money for me is significant. The way to stay disciplined and cold-headed in the market is to reach the amount of money that does not matter for you until you can adjust and level your risk tolerance up to a little bit higher. So protecting your gains and avoiding overconfidence is, for me, first of all, remembering that every next trade can turn out as a losing trade, and being willing to accept it, and knowing that it is okay and this is a market. Remembering and asking myself, am I willing to accept this loss, and am I going to regret it, or am I accepting the possibility of losing this amount of money? And if I know that this amount of money that in my account is currently, after the account has grown, is above what I feel confident and comfortable with, to withdraw the part of money that you've gained and start trading with the account size, again, that you feel comfortable, confident, and calm. Number 3, what's the worst case scenario if your next trades don't go as planned? This is also a really good question to ask yourself, because if you would ask yourself this question, if traders would just keep this one question in mind, there would be so less traders that would be blowing their accounts. Imagine before you take this one trade that ruins it all, that blows the account or blows half of it. If you would, before this trade, ask yourself a question: what is the worst case scenario if my next trade is lost? Would you still take such a huge risk or not? I would say not. I would say you wouldn't. I wouldn't. Going back to my beginning of my trading career, when I was blowing one account after another, if I would just be thinking that if I do this, if I press this one button, my whole account, the whole work that I put in for weeks or months can get like thrown in the trash within the next hours, I obviously wouldn't press this button. So this is a really good question to ask yourself. Write it down, put it somewhere in front of you, and at the moment of decision making in your trading, ask yourself this question. It can protect you from losing money, losing time, and losing lots of effort that you took to build up your account in the first place. And the fourth, how would you adjust your risk management moving forward? Would you perhaps lower the risk if the next two trades turn out negative? Would you perhaps step away? Create the list of set rules that are going to help you to control not your risk, but your emotions and yourself from getting in your own way. People say risk management. I say risk management ties back into emotional management. Because risk management, even if you have this whole set rules, they all get thrown out the window and walk out the window the moment we become emotional. So what we really need is not the risk management rules necessarily, but the rules to manage our own emotions, the rules to know our strong and weak sides, the ways to maximize the profits from our great side, the strong sides of our personalities, and then minimize the impact of the weak sides of our personalities. This is something that I believe, and I hope it works for you as well. Now, let's go into the fun part. Now, the fun part finally is the last quiz for today before we move on to the practical aspects of risk management. I've got something very special for you, and this is a test to reveal your trading personality and risk appetite. Are you a cool-headed strategist, or perhaps a thrill seeker chasing volatility? The type who dives headfirst into risky setups, or perhaps the investor who prefers solid ground under their feet? Who are you really? This test will show you how you make decisions and why it matters for your trading results. So you might even discover something about yourself that you never realized before. Are you ready to face this truth? And let's have a look. If you are ready, can you please put a plus in the chat before I'm going to explain the two questions of this quiz? If you're ready and excited, put the plus in the chat. Some time ago, this test really did help me a lot to realize some things about myself and being able to also adjust my system towards my personality type. Okay, I see lots of pluses in the chat. Let's get started. Quiz number 2 will contain 2 questions. Okay, second quiz, 2 questions. The first question is, which box would you take money from for yourself if you could do it repeatedly, again and again and again? Would you be taking the money from box A or from box B? In box A, you have both their circles, right? The balls with $100, but also sometimes you have a ball with $0. In a box B, you have the balls with $70 only. You have many of those, but they all contain $70 at once. In box A, you have many balls. Some of them are $100. Sometimes there is a one with 0. In box B, they have many balls, but only $70 at once. Let me know in the chat, which box would you be taking money from? Okay, I see Ravi is saying B. Said is saying B. Great. Michael is saying A. Tomek, B, A, B, A. Okay, B. Okay, great. The most important that you mention it for yourself as well. And thank you for sharing it with me in the chat. Remember your answer. Okay, the first letter, remember, write it down somewhere. Question number 2, are we ready? Question number 2. Which box would you give the money away if you would need to do it repeatedly? If you would need to give the money away to someone, doesn't matter to whom, again and again, which box would you give the money from? For box A, which again, sometimes there is $100 in a bowl, sometimes there is $0 in a bowl, or box B, which is $70 each time. Okay, $70 each time in each bowl, so safe. In the box A, it's sometimes 100, but sometimes 0, so you don't need to give money away sometimes at all. Right? What would you choose, box A or box B, to give the money out to someone else? Let me see. Said is saying A, Hylas A, B, B, A, okay, B, B, B. Okay, great. Thank you for answers. Perfect. Okay. Okay. Tomek says B, Salvador B, Dave B. Great. Now remember the answer. The number of the ball in the box doesn't matter because it's indefinite. There is an indefinite amount of balls in each box. We don't know how many of them. There is like indefinite. They always are in this box. It's about the decision that you are making. Where are you going to take the money from? Where are you going to give the money away from? So if the amount of boxes is indefinitely, would you give the money from A or B, and would you take the money from A or B? Write it down. Would you go for AA, or perhaps A, B, or perhaps B, B, or perhaps B, A? Okay. Ravi says AB, great. AB, okay, good. Do we have anyone else? AA, great. Perhaps BA someone, or BB. BB, great. Fantastic. We have different kind of answers. Now, this is time right now to have a look at what does it say about your personality type as a trader. Are you ready? Let's move on. Type AA. If you answered AA, okay, we had a couple of people answering AA. Those are the people who are the risk takers. They take risks in everything, sometimes even if it's unnecessary. They try to rapidly grow their account, risking all of it from time to time. In this exercise, they are break-even because sometimes they're going to win, sometimes they're going to lose. But in trading, they consistently lose their account over time due to the lack of emotional control. And this is usually what happens. Risk takers need to improve their approach to risk management and to know that they need to sometimes calm down and press a brake before taking the next decision. Those who chose the AA, let me know in the chat if this is something that you feel can be the work point for you. And we are moving into the next type. The type BB. We had many people answering BB and choosing both options to give away and to take the money from the box B. Those are the steady people. They are not usually willing to take risks. They prefer and need financial stability and security. In this scenario, like type BB, AA, they break even because they give away and take $70 at a time. But in reality, they usually lose money due to commissions. They usually break even, but unfortunately, commissions also is a thing in the market, and they also take the money from us as traders. Type BB has minimal tilt tendencies and find it easier to manage losses. However, they do need to develop their risk management skills, and a little bit higher risk tolerance if they are willing to make money in the markets. They are usually best suited for conservative investments, and their high risk strategies or scalping can be too stressful for the steady type, for those who chose options BB. Type BA, the optimist. They hope to get lucky and avoid losses because they take the money from 70 continuously, consistently. They take money, they are not willing to risk the money to lose the money. However, they hope that when they take the ball and give away the ball from the box A, they're gonna get the ball with a number 0. They also want to hit the lottery in every situation, but isn't truly prepared to take losses. Over time, both in exercise and real life, they unfortunately lose money, but they might make some in the short term. They are highly prone to tilt because it is something that is happening when that trades that you expect to go good don't go good, and they need to learn how to manage the risks correctly, because other than that, the losing more than you on average win is always going to turn out negative. And it's crucial to shift your mindset about risk management before investing again, because once again, when you take the money always from 70%, because you are not willing to risk and take losses from time to time, but you give the money away hoping that you're also not going to get losses, it's still going to happen. Losses are still a part of the game always. And from time to time, we're going to all have them, no matter how long you've been trading, no matter how good you are. And you do need to manage your approach to risk. And type AB, the trader and investor, those people already by nature know how to manage risks. Over the long run, both in the exercise and the real life, they make money and it comes much easier for them. They are better at handling emotions and suited for trading and investment in high and medium risk assets. So those are the people who can go both for scalping, intraday, intra-week, and the long-term investments. What is really important is that all of the types, there is no wrong or right. There is just strong sides and weak sides of personality, and we all have them, each and every single one of us. There is nothing wrong with that. And I'm going to tell you in advance already that a couple of years ago, I was a risk taker. I was a person who, it goes against like what I believe now, but a couple of years ago, I was a risk taker. And I know about myself that I am their risk-taking person. Like I can never go to casino, right? I shouldn't be. I am a competitive person. And in life, it really suits me well. Whether it's in the market, it goes and works against me. And as long as I know about this, and as long as I accept it, and as long as I'm honest about my own weakness and about my own weaker sides, I can find out the approach that works for me and helps me to minimize the impact on my weak sides into my trading. For me, as a risk taker, what worked really well is taking one trade a day, is having something else to focus on besides trading, to not put all my hopes, my competitiveness into the trading. But for example, for me, it was a sport. For me, it is a mountains. And for you, it can be something else. But to divide your attention and this urge to take risks and feel high emotions in something else than trading. For other types, for the type BB, for the type BA, you also can figure out, based on this quiz, your weaknesses and weak sides, and minimize the impact of it. It's not about who can be a better investor. It's about knowing yourself, being honest with yourself, and knowing how to work with what you got. Let me know in the chat if you found yourself a little bit somewhere true in this 4 types of traders. I can see Timur says, yeah, that's me. I'm the optimist. Yeah, tilt, Dave is saying. We all have a little bit BA, I guess, sometimes. Interesting quiz. I do hope this quiz was interesting, and sometimes it's uncomfortable to face the truth about ourselves, but the sooner we do it, the easier it will be for us to move forward and to actually become profitable. And the longer we try to lie to ourselves, and the longer we are not able and willing to face the truth about our personalities, the more difficult it will be to work for us on our weaknesses and strengths and find the strategy that works for us. I found myself as an A. I need to become BA. I need to become perhaps AB. Discovering myself. Great, fantastic. I'm really happy that this quiz helped. And now I hope that you know better on what to focus on next time when you will be working on your risk management aspect as well, not only from the technical perspective, but also from emotional one. However, now, as you know who you are in trading and your weaknesses as well as the strong sides, which again, we all have, so nothing wrong with that, let's have a look at a few of my personal risk management rules which you can adapt to your own self-preferences and needs. First things first, I say to myself, and this is one of my rules, that I should never lose more on a losing trade than my average profit on a single trade. Giving you an example, the average profit, let's say your average profit on a single trade is $500. None of your losses, not even one loss, should be more than $500. Why? Because it will help you to build the profitable trading system easier. When your losses are much bigger than your wins, it becomes extremely difficult for you to even come to the break-even point, not even talking about becoming profitable. We all take losses. New traders, long-term traders, bad traders, good traders, profitable traders, losing traders, we all take losses. This is an inevitable part of our trading. The difference between the profitable trader and losing trader is how do you handle losses. The profitable traders learn over time how to cut your losses short and how to accept the small loss for the purpose of getting the big win afterwards. Where there's losing traders are not willing to accept the loss. They hold on to the trade. They hope it will eventually reverse. They pray to all the trading gods, hoping that this moment market will go their direction. And they are unwilling to take small losses. They end up taking big losses. Everything is great. Small losses, small profits, besides big losses. This is one thing that should never happen in your trading, and this is a huge shift point in the consistency. If you can manage to make sure that none of your losing trades is bigger than the average profit that you make on a single trade. So find out what your average profit is. Have 100 trades as an example. Calculate the average profit and make sure that none of your loss is greater than that. Second rule, it's crucial to define the risk per trade, the risk per day, the risk per week, and the risk per month. This is something a lot of people forget. They define eventually the risk per trade, maybe the risk per day, but they forget about the risk per week and the risk per month. And why is it crucial? Because some weeks are going to be really bad. For example, I personally know up until this point, after years of experience, I know on Tuesday if my big week is going to be really bad and I should step away from the market immediately. I can see by the market and by my performance on Monday and Tuesday that this week is not the week. If you don't have something like risk definition per week and per month set in stone, it's going to be much easier for you to blow your account or have a huge loss because you don't know where to stop. It's all about knowing where to press a break. How do we define this? Well, we identify after each losing trade, your next one is almost always a loss, and set a rule to limit the number of losing trades per day. Which means going through your trading system, through your back testing or through your trading journal, seeing how many trades do you usually take before you start losing it emotionally and physically, your money, and putting a break before it happens. Let's say your risk tolerance is 2 losing trades, and you know that after 2 losing trades, you start feeling bad, you start feeling regret, and you start feeling urge to revenge trading to get the money back. Then put a break after 2 trades losing in a row per maximum per day. The same you can do per week, the same you can do per month. Let's say if my risk tolerance per day is 0.5% per trade, 2 trades is 1%, then per week, let's say is 3%, per month is going to be, let's say, 6%, 9%. This helps you to save your account even if you have losing streaks, even if you have the bad months, even if Trump becomes a president, even if FOMC starts raising or increasing their rates, even if the whole world is going crazy, these breaks will help you to save your account and all the work that you put in. Fourth, daily risk should never exceed 1/3 of your weekly risk. Once again, if my daily risk is 1%, then my weekly risk is 3%. And I shouldn't be risking more than that, because by definition, my weekly risk shouldn't be exceeding 1/3 of my monthly risk. So if my weekly risk is 3%, my monthly is maximum 9%. 1/3 is more than enough to know that the trading is going bad. Okay, the trading is going bad, and you shouldn't, one second, apologies, and you shouldn't be going for more, trying to get back what you lost. The market sometimes is bad, but the worst thing is to lose everything on your bad day, wake up next morning and see lots of great opportunities that could have brought you great profits if you would just stay consistent. And the worst part about it is to not have money anymore to continue trading and use all these great opportunities because you didn't stay disciplined on a bad day. If it ever have happened to you, let me know in the chat. It did happen to me, and that's exactly why I have these rules in place, to save my account and all the work that I put in and my time. Sixth, aim for higher risk to reward ratio, but never less than 1:1. And I want to take a moment to focus on this key point that often sparks heated debate among all the traders, the risk to reward ratio. And let's move on to a fundamental principle of it. What is it in the first place? Well, risk to reward ratio is the ratio between how much you're risking on one trade and how much you stand to gain. For example, if your stop loss is, let's say, 20 ticks and your target is 30 ticks, your risk to reward is 1:3. If you are risking $100 to potentially gain $200, your risk to reward is going to be 1:2. Mathematically, it looks like this. Risk to reward essentially equals potential loss divided by potential profit. And why does it matter? Why does it spark such a debate among different traders? Well, because even with a low percentage of winning trades, you can still be making money as long as your risk to reward is profitable, it's favorable. However, even with 90% winning rate, you can be a losing trader if your risk to reward and risk management walks out the window. The first thing, before we're going to move on to a couple of practical examples where I'm going to demonstrate to you how different risk to reward works, what risk to reward do you usually aim for in your trades? Pick one and let me know in the chat. Is it 1:1? Is it 1:2? Is it 1:3? Or perhaps it's 1:0.5? Let me know in the chat, what is your usual aim? What is something that you aim for? What is usually something that you get from your trades? 1-to-1 minimum. Timo says 2-to-1. Okay. 2-to-1 essentially means that you are risking $200 to gain potentially $100. I have lots of answers here in the chat. 1-to-3 or greater, 1-to-3, 1-to-2, 1-to-3 and trail, at least 1-to-2. Fantastic. Great. We did have a couple of answers as well. 1-to-1, 2-to-1. Fantastic. I see that many of you are working with risk to reward 1-to-2 and higher, and that's a really, really solid foundation for trading with a very high potential. Now, let's break down and look how different risk to reward statistics work in practice. And what win rate do you actually need to just be break even depending on your risk to reward? Here are the conditions for our imaginary trading system that we're going to be testing. Imagine that we have a trading system. We take 100 trades. Your risk per trade is fixed, let's say 1 unit, which is $100. And we will be calculating how many of those trades need to be winners to at least cover your losses and hit break-even point. Let's talk about the risk to reward 1-to-0.5, meaning that you are risking $100 to gain $50. As we can see, based on the mathematical calculation which I did for you today, you need 67 trades, 66 and a half exactly, to be precise, to get break even. That's not talking profitable. This is to get break even without calculating in the commissions that you pay for opening and close trades. So out of 100 trades, 67 need to be profitable without commissions to just get to zero. Let it sink in. You need 67 out of 100 trades to be winners, to be at zero with risk to reward 1-to-0.5. Risking $100 to gain 50. Let's have a look at risk to reward 1-to-1 and notice how our break-even point gets lower. We still take 100 trades. We still risk 1 unit per trade. So we are not taking the progression in. We risk $100 per trade. And in this example, we risk $100 to gain $100. If you risk $100 to gain $100, out of 100 trades, you need 50 trades to be profitable, 50 trades to be winners, to get break even. Once again, it's not calculated in the commissions. It's just to get at zero without even paying commissions. So you need to get 50% profitable, 50 trades out of 100 winners to get break even. However, compared to 0.5, we see how the break even points gets lower. Let's have a look at the risk to reward 1-to-2. Risk to reward 1-to-2, where we risk $100 to gain $200. In this example, we still take 100 trades, but we only need 34 winners to become break-even. So only 34 trades out of 100 I need to have winning to get at zero. So my 66 trades can be losses if just 34 are winners at risk to reward 1-to-2, and I'm already going to be at zero, and I'm not going to be losing money. Let's have a look at the risk to reward to 1-to-3. 1-to-3 risk to reward allows you to become break even at 25 winners. So if you have only 25% trades winners or 25 trades winning out of 100, you already will be break even based on 100 trades statistic. So you don't actually need much. You can have 75% trades losing and you still will be break even if you have 1-to-3 risk to reward. So this is extremely interesting. Notice how with high risk to reward, your break-even point goes lower and lower and lower. So we are actually looking at the practical example that this chart is not just pretty lines. It shows us the fundamental principle which a lot of new traders completely miss out upon. The higher the risk to reward is, the lower win rate, the less accuracy you need to have to be profitable. With 1 to 3 risk to reward, you need to be winning only 26, 27 trades out of 100. You will be profitable already. Everything above 25%, you will already be profitable. This can extremely much ease your profitability in trading, because you don't need to be right every single time. You don't need to be even right 50% of the time. However, if you are running and chasing the idea to predict the market at 8 trades out of 10, you are only making your life as a trader more difficult. Much more sustainable approach is to get a few good trades with a good risk to reward. And even if your win rate is less than 50%, you can still be profitable. However, I still want to make a very important remark. High risk to reward is not the magic wand that will always work. Every trading system has its own limitations and its optimal risk to reward percentage. So, for example, if you are a scalper and you are catching the short moves intraday, risk to reward 1 to 4 may be just impossible for you to have. Maybe it is possible, but maybe it's also not. It's not sustainable. You will be waiting for the take profit, which market will simply not be given, and reversing before your profit is reached. So your task is not just to aim for as high risk to reward as possible, but to find something that works for your specific trading strategy, for your specific trading system. How do we do this? We do this through the back testing. When you test your trading system on a big amount of trades, and once again, we take at least 100 trades as an example, not less than this, you will be able to check which stop loss size is still protecting your trades from the market going against you, however, not getting hit before the market reverses to your profit. And also you will get the appropriate, the adjustable take profit, which is allowing you to get maximum profitability from your specific trading system, but the market will still be able to reach it. So what did we learn in the past couple of slides is that the higher risk to reward is, the easier it will be for you to become profitable, even with a lower risk rate. And I do hope that this visualization really helps you massively to visualize it, because in theory, we all know it. We all know that it's easier if you have the high risk to reward. However, when we actually get in the market and start trading, it becomes much more difficult for us to remember the fundamental principles of trading. However, with all of this, risk to reward shouldn't be completely out of the blue and should be still adjustable and in fit to your trading system. The optimal decision is to find the correct risk to reward, stop loss size, and take profit size through backtesting for your specific trading approach. And this is the smart risk management is based on. Not emotions, not guesses, but data and statistics. Okay? So I do hope that this a couple of slides, were able to help you to visualize how important it is to get the high risk to reward, but still be able to fit it to your personal needs. And let's take a moment now to focus on one key point that a few trading webinars truly address. And that's what traders bring into the market before they even place a trade. The truth is, okay, and I don't have slides for this, so I'm gonna turn it like this so you can see me. The truth is that we all carry into the trading a specific mindset, the psychological framework which doesn't match the realities of trading. So we carry into the market our own fears that we don't sometimes even recognize. The fear of not living up to someone else's expectations, the fear of being punished for doing well and earning lots of money, the fear of disapproving, the fear of missing out, the fear of success or the fear of failure, the fear of making wrong decisions and regretting it. Let's pause here for a moment and reflect, because this is a key in the risk management, not necessarily technical aspects, but the emotional aspect of it. Many traders carry the deeply rooted idea into the trading that there is only one way to succeed. And if I don't find a path, it means that I've failed. That belief alone creates a tremendous fear and pressure of making mistakes, because if there is only one correct way, then every deviation from this path is going to become a failure. Every misstep becomes unacceptable. And in trading, by its nature, it's a game of uncertainty, it's a game of probabilities. And what happens? Well, traders collapse under this pressure. Traders collapse when they start taking losses and they are unable to accept them. Which brings us to a very important turning point. What meaning do you attach to your mistakes? What does it mean for you to take a loss in the market? What do the losses say about you? What do you feel that they say about you? Is every loss becoming a story about that I'm not good enough? Or perhaps if every mistake is a reflection of your self-worth as well? Then if this is the case, then your entire dignity, your entire identity is on the line every time you click a buy or sell button. This is what's often called the perfectionist syndrome. And we bring this mentality into the market, and it becomes for many like a turning point in the trading career. So the mistakes for us equal failure, and that errors makes us less worthy. We never develop a healthy relationship with money, as well as making mistakes. And now, as traders, we become our hardest critics, our biggest enemies. And we get into our own way with no teacher to guide us, with no coach to help us, no objective score to manage our success, just the charts and just the P&L graph. So let's talk about their attitude towards winning and losing before we're going to be finishing off our today's webinar. I'm going to be answering a few of your questions. So if you ask any trader what their goal is, and you will listen to the answers, you will hear a lot of versions of I want to win, I want to be right, I want to become a 7-figure trader, I want to manage huge accounts. And you know what it really means? I want to win, I don't want to lose, I want control, and I want certainty. And this is why people buy expensive courses where they chase the secret strategies. They spend thousands of dollars because deep down they believe that if I study hard enough, if I pay enough money, I will finally find this money button and I will win, and I will not be losing any longer. I will not take any more losses. But then comes the truth about the market. No matter how hard you work, no matter how hard you try, no matter how good your strategy is, you are still not in control of the outcome. And that realization breaks people. They realize I can do everything right and I still will be losing. And they realize that the market doesn't reward perfection. It rewards adaptability. It rewards being able to accept that losses will be always there, no matter how hard you try. And this is why I always say, I've never met a truly great trader that wasn't a phenomenal loser. Every great trader is absolutely phenomenal, is taking losses. So being a good loser means surviving. It means don't staying in bad trades, cutting losses short, Don't keep adding money to trades that are already going wrong. And if there is the trade that no longer meets your criteria, you get out. You don't sit in and hope the trade is going to massively somehow reverse. And that's it. That's a risk management. So being a good loser is what keeps you in the game long enough to become a consistent winner. Let me say it again. Being a good loser is what keeps you in a game long enough to become a consistent winner. But to get there, you have to change your relationship with uncertainty. You have to change your relationship with losses. So the most traders already know how to make money. You know how to make money. Finding opportunities isn't that hard. For the past 5 webinars, we talked about multiple setups from the volume perspective, from the order flow perspective. And by the way, in the next webinar, which is going to be already this week, I'm going to be talking about how to combine this all in a trading system. So make sure that you attend as well. So you have it already. It's not difficult. The hard part is managing emotions. It's managing risk. And again, management risk is not about only numbers or techniques. It's about habits, it's about subconscious behavior, and it's about managing, knowing our emotions, weaknesses, and strengths. And let me walk you through the process that I've seen in myself and others that comes to behavioral change in trading before we're going to finish it off. Because a lot of the times we make mistakes. Let's say we blow our account and we say, hey, I'm never going to do this again. Have you ever had this before? Let me know in the chat if you have ever had this, that you said to yourself that you will never do something again in your trading. And the next day you wake up and you do it again. And you're like, why? Why did I do this? Have you ever had this? Put me a 1 in the chat, because I did. I was like, I'm never going to do this again. And the next thing I know, I'm doing this again. Sometimes it happens, right? So why is it so difficult to stick to our own promises to ourselves if it comes to trading? Because it's a habit. And to change a habit, there are several stages. There is nothing wrong with you. We just hope that it happens faster than it actually can. Stage number 1 of making mistakes and changing the habit is awareness after the fact, post-fact. So when you realize that you made a mistake after the trade is over, you review your trades and you go, why did I even do this? Why did I even make this mistake? And this is where we most start. We take the trade, it ends up bad, and we are like, well, that was definitely a mistake. That is stage number 1. Stage number 2 of changing bad habits is awareness in the moment. After some time passes and you consistently review your trades and you consistently note that you make the same mistakes again and again, you start recognizing the mistakes in real time. I'm making this mistake right now. I'm in the trade and I'm making this mistake and I'm aware of this. Now, when you get to the stage, your goal here is to take conscious action, to exit the trade immediately and break the pattern. The worst thing you can do is to keep holding the bad trade when you know it's bad. This stage is absolutely crucial, because if you know that you're making a mistake and you stay in the trade anyway, you are reinforcing the negative behavior. But if you train yourself to act, to stop, then you are reprogramming your response, and you know that you shouldn't be doing this mistake and continuing this habit again. After you do this, if you consistently change your bad habits, if you consistently exit the bad traits when you recognize them, you're going to get to the stage number 3. The stage number 3, and when you anticipate before making the mistake. This is when you sense the mistake before you are about to make it. You're like, okay, I am going to over leverage and I'm not going to do this. Or I feel like I'm going to revenge trading and I'm going to go take a walk. Or I feel like I'm attached to this previous loss that I took and I feel like it's going to affect my next decision. And you don't do this. You stop yourself before you act, and now your behavior is changing at the level of your identity, and your habit is reprogrammed. There are 3 stages. A lot of us expect the habit to be changed by the step number 1, but we just need to keep going, recognizing the mistakes, reinforcing the good behavior, changing the bad ones, exiting bad traits without hoping that it's going to get to break even, accepting the small loss, learn how to take the small loss, learn how to let the winners run. And over time, you're going to get closer to recognizing the mistake before you make them. And this is when your habit is changed. So what can help you to build the correct risk management system for yourself? First, backtesting. Like athletes train before the game, traders must train before risking real money. So the second is journaling your trades, because I know that it's boring. I know a lot of people don't do this. Atlas actually helps drastically because you have the automatic trading journal there. So even if you don't journal your trades, you can still go back and you can still go through them. Atlas does it for you. It even creates the statistics of your trading account. It's crazy good. It's right in your main Atlas window, your statistics. So make sure you go check it out. And when you write down and review your trades, write down also not only technical aspects, but how you felt, emotions, charge, and you will be able to fix it, because you cannot fix something that you don't see. You don't know it, you can't fix it. You realize that you're aware of it. This is the first step to the change. Next, gradually increase your position size. So don't go from 1 to 10 contracts overnight, because it will break your risk temperament and your tolerance to risk, especially if it's a funded account. I already saw the question about it, because you need time to regulate your emotions. So go step by step. And remember, 1 trade is random. Result of 10 trades is random. But after 100 trades, you begin to see your system. That's what we measure. If you blow your account on 1 trade, the problem isn't the trade. The problem is that your risk management went out the window. And again, don't evaluate your trading system based on 1 trade, 10 trades. Evaluate your system based on the long run. Let me have a look at your questions before we're going to be finishing off today's webinar. And I hope it was useful for you. Let me know in the chat your feedback. I'm eager to hear your feedback about today's webinar. It was less technical. It was more emotional, let's say, like this, and psychological aspect of trading. But I find it sometimes if it's more important than the technical part. Are you journaling your wins too? Of course, journaling both wins and losses is extremely important, because you can find out what is similar in your losses and what is similar within your wins. You can find out your A-type setups, A-plus setups, which are lower risk, more like extremely profitable setups. You can divide them in the groups, and you will know which setups are your your go-to setups. If you don't journal your wins, you also can't know which setups are really good. So make sure that you journal both and you take conclusions from both winners and losses. Regarding statistics tab, when time permits, can you show us how to view the stats? We can do this next webinar, because on the next webinar, we're going to be talking about the trading system, how to combine everything that we've learned throughout the past webinars in one trading system. And we can also have a look at their stats page on Anas. If you just bring back your question to the next webinar, please, Nemsa. Let me see. I saw another questions. Waswad is asking, do you have any advices on how to not fail the prop contests? It's about the risk management. Now, the problem with a lot of prop accounts in general, and I'm not going to advise them or anything, the problem is here that a lot of people think that they have much more money than they actually have. If you take the prop account for 100,000 and you have 10,000 to risk, you actually trade on 10,000. So if you risk 1,000, then it means you're risking 10% of your account, not 1%. So adjust your risk management, Waswad, to the actual amount of money that you have, and the actual amount of money that you have is your drawdown, maximum drawdown, not your whole numbers that the account shows. All of this is margin that allows you to take the trades, but adjust your risk management to the amount of money that you actually have as a maximum drawdown. Let me see some other questions. Would you recommend ending the day after the number of successful trades? It depends on your personal on your personal statistics. What you do is you go through your back testing and you see if you, after a certain amount of winners, you start feeling overconfident and you start losing it, then you definitely should put the break as well. I don't have this issue, so if I have a very good day, I might continue trading. I never increase my risk, so my risk is always staying within the same percentage of my account. But this took me years to get to. And I accept that if the next win happens, I'm going to step away. If you find out that after a certain amount of winners, you start feeling overconfident and start losing all the profits that you've made, then you should take a stop. You should make a stop and a break after the certain amount of winners that you took. Let's say 2-3 wins, and that's enough. Thank you so much for the kind feedback. I really appreciate it. And it does mean a lot to me to see this feedback. Thank you so much. Said, I use laptop, which because I've been traveling a lot throughout the past years, I've been constantly moving. That's why I use a laptop. However, I am going to be getting my PC, and I do not recommend to use your phone. The reason behind it is because you can be busy with something completely else, and then you take your phone and you take a trade out of nowhere, and that trade is always going to turn out bad. Beside this, you cannot see the clear picture on your phone. It's impossible. The screen is just too small. I use ARAS on my laptop, never had an issue with this, so I recommend laptop or PC, something with a big screen. ADAS always will help you also to make the conscious decisions without just jumping in the trade because we suddenly saw something on the phone by accident, and it's going to save you a lot of money as well. Thank you so much, Salvador. I really, really appreciate that. It was nearly an adventure today. Thank you for the feedback. It is always wonderful. Thank you. It is always wonderful to have you here with us. And that is really good that we don't have ARAS on the phone, because trust me, much more people would be losing their money if they would have it on the phone, because it's impossible to see the full picture from the small screen, no matter how hard you try. Thank you so much for the kind feedback. Thank you for the feedback in the chat. I really appreciate it a lot. And I do hope to see you on the next webinar. It's going to be the closure of our marathon, so make sure to attend. We're going to be talking about how to create your trading system. And remember that if you have any questions after the webinar is finished, you can still text us, text the support on ADAS, subscribe to the Telegram chat bot as well on ADAS. And this is the fastest way to get all the information. And the recordings of all webinars always are in your email, so you continue to have the lifetime access to this and rewatch them as many times as you need to repeat the information. I will see you on the next and last webinar of the series to create their trading system and combine everything that we've learned for the past weeks in one profitable system for you as a trader. So thank you so much for being with us today. Have a fantastic, great day and week ahead. And I will see you on the next webinar with us very soon.